I'm joined in the studio now by George Buckley, Chief UK Economist at Deutsche Bank. Thanks so much for coming in to speak to us. So what are your expectations? Could we in fact see an interest rate hike sooner than expected?
I think it might be a bit later. I mean, our forecast is that we wait until next year until we see higher interest rates. And the Bank of England's juggling with a few things at the moment. We have the austerity package, which is likely to weaken economic growth. It is going to raise inflation in the near term because it increases VAT, but in the longer term it might have a negative impact on inflation to the extent that it reduces government spending, it reduces GDP, and that makes it even more difficult to get back to that peak level of output we saw at the start of 2008.
And of course we heard Chancellor George Osborne there speaking about his budget cuts. Just put this into some perspective for us in terms of where the monetary policy fits in with the government's austerity measures.
Well, government spending is worth around about a quarter of total economic output or spending, and that means it does have quite a powerful impact. If you cut spending, you're also going to cut the direct impact that it's having on GDP. So it is going to have a negative impact on inflation going forwards to the extent that it weakens economic output. And of course the Bank of England has to take that into consideration. However, also, if you reduce government spending, it also means that it's less likely that you get downgraded. It means that interest rates in the economy are going to be lower, your government bond yields are going to be lower, and that in turn means that private sector spending might be stronger because, of course, private sector interest rates do depend upon government interest rates as well, and that means that if government rates go down, so too do interest rates faced by the private sector. It does stimulate private sector demand as well if you engage in these austerity measures.
Right, so what does that ultimately mean for consumers?
Well, it means the Bank of England's got a very difficult job to do because they've got to work out how much of an impact that has. In terms of consumption, it's been relatively restricted recently. We're expecting that consumption won't be particularly strong over the next couple of years. We don't think the recovery in total will be that strong. We're forecasting between 2 and 2.5% economic growth. It's less than what the Bank of England's forecasting at around about 3% per year over the next couple of years.
And of course, the level of inflation has already prompted Andrew Sentance, a member of the Monetary Policy Committee, to really call for higher interest rates. Are we likely to see anybody join him in that argument? Well,
the core inflation dynamics in the UK are much worse than they have been, for example, in the US or the euro area. In the US, we've just seen inflation around about a 40-year low in core terms. In the euro area, it's around about a 20-year low. In the UK, it's not far off a 20-year high. Now, of course, we saw some numbers yesterday which showed core inflation looking a bit better. But I think some members of the committee, such as Andrew Sentance, are very worried about what higher inflation is going to do to inflation expectations. They really don't want to see these second-round impacts coming through inflation expectations and also wage and price setting. Right,
so how do you assess the possibility of this point of a further round of QE quantitative easing?
I think the risks are probably evenly balanced towards both a rate hike this year and also more quantitative easing this year. It's something that the Bank of England will be thinking about. The Governor, of course, talked about the possibility of thinking about both more QE or indeed higher rates. It's a very difficult balancing act that the bank is engaged in at the moment. I personally think there will be no more quantitative easing and they will have to raise interest rates over the course of the next 6 months.
George Buckley, Chief UK Economist at Deutsche Bank, thanks very much.